Good evening, traders. What a fascinating day in the markets. Sensex closed at 81,583. But behind this seemingly quiet close lies a story of intense battles between bulls and bears, strategic positioning, and critical support levels that held firm. Let me walk you through exactly what happened today and why it matters for tomorrow's trade. The day began with Sensex showing signs of weakness. Look at our charts. You can see those early red candles pushing the index down from the 81,600 levels. This wasn't random selling, it was strategic positioning by smart money. The open interest data tells us exactly what was happening. Call writers had already built a massive position at the 81,600 strike, creating a resistance that would prove difficult to break. As the market opened, these call writers defended their position aggressively, pushing prices low. The index quickly fell through 81,500 and tested the 81,300 and 200 levels. This is where today's story gets interesting. Around mid-morning, Sensex made a decisive move around to test 81,300 level. This wasn't just any support, the open interest data shows massive put writing had accumulated at 81,500 levels, with additional support building at 81,400 and 81,300. Think of it this way, put writers are essentially betting that the market won't fall below these levels. They are collecting premium by selling insurance to nervous traders. When we approached 81,000, these put writers had two choices, defend their position or face losses. They chose to defend. You can see on the chart how price rebounds sharply near 81,300 levels, creating that long lower shadow on the candlestick. This wasn't retail buying, this was institutional support kicking in exactly where the open interest data suggested it would. Post 130, the market entered a fascinating phase. Sensex began oscillating in a range between 81,500 and 81,600. This wasn't a coincidence, it was the market respecting the open interest boundaries. Look at the OI distribution. 81,500 put, maximum open interest acting as support, 81,600 called maximum open interest acting as resistance. The market was literally trapped between these two massive positions. Every attempt to break above 81,600 was met with a fresh call selling. Every dip towards 81,500 put saw put writers stepping into support. This created what we call max pain, the point where option writers on both sides lose the least money. Today, that point was right around 81,500 and 81,600. From a pure price action perspective, today painted a clear picture. The sharp morning decline tested conviction and shook out weak hands. The V-shaped recovery confirmed 81,300 as strong support. The afternoon consolidation established 81,500 and 81,600 as a new battleground. This typically signals that sellers tried to push the market lower but were overwhelmed by buyers. It is often termed as short-term bullish signal, but given the strong call writing above, any upside might be limited. Today's market action was a masterclass in how options positioning influences price movements. While the gain might seem insignificant, the intraday journey revealed crucial levels, institutional behavior, and market structure that will guide us in the coming sessions. Remember, in market like today's, the real money wasn't made in directional bets. It was made in understanding the range and trading accordingly. That's all for today's analysis. If you found this video helpful, don't forget to like and subscribe. Trade smart, trade safe, and I'll see you tomorrow with another market breakdown. Happy trading.